Hello everyone and welcome to the Week in Markets. We're going to focus in on central banks this week. We have had interest rate decisions from both the Federal Reserve in the US and hot off the press, the Bank of England here in the UK. Delighted to be joined by Faye Graham, investment analyst here across the portfolios. Faye, let's get straight into it. We'll go with the Fed first, given most exciting decision. Could you update us on what decision was made and what the policymakers there are thinking about?
Yeah, of course. So they cut interest rates by 25 basis points, which was widely expected. So that takes the policy rate to 4 to 4.25%. And it was the first cut that they've made since December as well. It was a largely unanimous decision, so all of the members except for one voted for the 25 basis point cut.
And of course that one person who didn't vote for a 25 basis point cut, what did they vote for?
A larger cut, so it was 50 basis points.
So this would be the chap who was one of Donald Trump's preferred members who just joined the committee on Tuesday and immediately dissented. So that's not a normal phenomenon, but it does show that the direction of travel. Yeah.
I guess thinking about why they resumed interest rate cuts, obviously I mentioned the last cut that they'd previously done was in December. Just thinking about, obviously they have a dual mandate, so they look at both inflation and also the employment rate when they're setting interest rates. So looking at inflation, headline inflation's at about 3%, so well below the highs of 2022 and also only slightly above target. And it's been sort of around that 2.5% to 3% level for like the last year or so. I think where the more significant development has been recently has been within the labour market. So some of the recent NFP prints have been slightly weaker. And then also there was quite a significant downward revision last week to the jobs data.
And of course that's what they really worry, because history, the last 50 years or so of recessions has basically shown that whenever unemployment starts to rise, because of slowing job growth, it typically precedes a recession. So the Fed are trying to get ahead of this.
Exactly.
And in terms of communication, what do we think for the rest of the year, given the Federal Reserve will be meeting twice more before Christmas?
Yeah, so this meeting they actually gave us a summary of their economic projections, which is basically where they give their updated forecasts on economic growth, inflation and policy rates as well. There weren't really any huge shifts, but just some changes at the margin. So broadly expecting growth slightly higher than they were previously expecting, and that's for 2025 through to 2027. And then in terms of inflation, not too much change. Expecting PCE slightly higher next year, but expecting inflation to cool and get back to target by 2028. And then importantly, in terms of interest rate expectations as well, their expectations point to a further 50 basis points of cuts this year, and then a further 25 basis points in 2026.
So that's key really for the rest of this year. They expect to do two more cuts, cumulatively 50 bips, so that would take the policy rate down close to 3.5%. Yeah. Of course, today we're seeing new highs on the US equity market. The indices there, so they're taking it well. As you've pointed out, there wasn't any substantial revision to the growth and inflation outlook. They also were quite constructive on what they think their policy impact will be on employment. They actually expect unemployment to be quite contained 2 years ahead. So it's actually an incredibly constructive risk management cut is the way that the chair phrased it. So that's very constructive. That's quite interesting that we've got a new cycle of interest rate cuts in the US. Let's move on to something that wasn't quite as exciting, which was the recent Bank of England decision to hold rates steady. Could you give us some colour there on what the Bank of England might be looking at?
Yeah, of course. So as you mentioned, the held rate's unchanged as expected. So policy rate still at 4%. And looking at the voting members as well, it was, again, majority, so 7 out of 9 members voted to hold rates unchanged, with just 2 members voting for a cut. I think if we think about why they held rates unchanged, we had the inflation data earlier this week, which showed that UK headline inflation is still quite sticky at about 3.8%. So above the target of 2%, and I think actually the highest in the G7 as well. And just looking at some of those subcomponents within there, so services inflation in particular.
That's the real challenge.
Yeah.
It's services inflation, given just the nature of the economy. As you pointed out, that's what the Bank of England are really focused in on.
Exactly, yeah, that's still quite elevated, well above target at about 4.7%, and wage growth as well, you know, while slowing it's still quite high. So that's really the challenge that.
And of course, we should bear in mind that central banks are always forward-looking, so what they're trying to do is target inflation roughly 2 years ahead. So inflation today doesn't really matter, although it should, because it's a starting point. But what the Bank of England are probably constrained by is they still expect inflation pressures to rise this month. They're probably looking for a more concrete sign that inflation has peaked and has started to fall materially. Of course, that doesn't actually mean that prices will fall. It just means the rate of change of price growth will slow and to be commensurate with a 2% inflation target. But we should contextualise with what the Bank of England have already done this year, because they haven't been inactive. They've actually done a number of things this year before the Fed.
Yeah, exactly. So whilst, as I mentioned earlier, the Fed have actually held rates up until now, this year, the Bank of England have already made 3 interest rate cuts this year. So they've already done quite a lot compared to the Federal Reserve.
Great. Well, thank you, Faye. So it's really a week ahead of the Ryder Cup. It's really the number 4, which is dominating here, which is the Bank of England holding interest rates at 4% and the Federal Reserve lowering interest rates towards 4%. So it's helping to boost stock markets, of course, and that's great for portfolios. It's also helping the more defensive portfolios that are seeing bond yields fall. So that's great for multi-asset portfolios across the board. Well, that's all for today. Please do like and subscribe on the YouTube channel, and we will catch up with you next week. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.